My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. It's unbelievable. It happened again. I'm talking about how investors once again yesterday panicked and dumped stocks
Sell.
because they heard that inflation's running hot and the Federal Reserve has no choice but to raise interest rates.
Sell.
Look, it doesn't matter how many times they tell you these moments are buying opportunities, does it? They're not selling opportunities, they're buying opportunities. The steady drumbeat of fear always seems to win out over what I have to say. And that was very true yesterday, and it happened again today, where the economically sensitive Dow Jones Industrials tumbled 159 points. A lot of that's Disney. While the S&P 500 inched up 0.06%, and the tech-heavy Nasdaq rallied 0.52% in a magnificent display of power of everything that went down yesterday. Now, why does everyone fall for this? Why? I mean, why? Doing the show for 16 years, listen to me. Fear is a powerful motivator, and there's no shortage of people who are willing to say that the world's ending on any given day because of an overheated consumer price index number. They won't look under the hood to see that the main drivers of inflation came from oil, gas, used cars, all of which seem to be peaking right now. Now that oil companies are boosting production, automakers have begun to get their hands on more semiconductors right now. Like I keep saying, we knew this inflation number was going to be hideous. I told you endlessly that. But you need to remember that it's a backwards-looking indicator. There's a very real chance this will be as bad as it gets, which would mean an inflation-driven sell-off like yesterday is indeed a buying opportunity, and if you listen, it's already the case. Unfortunately, not many commentators seem to agree with me. No one agrees with me. I heard that every tech stock that got hit yesterday was finished for the year because, well, of course, we're in a high-growth stock bubble, which will be popped the moment the Fed tightens, which is going to be like yesterday. I heard Rivian, yesterday's red-hot electric vehicle IPO, represents pure speculative mania and that you better stay away. It's sowing the seeds of its own destruction. I heard that FAANG and their acolytes are kaput because when inflation is raging, nothing's worse than owning growth stocks. Finally, I heard that you can't buy the stock of any company that missed the quarter because those companies are now roadkill. All right, what can I say about this stuff? Simple. Don't believe it. It's nonsense, and I'm going to tell you why. Let's first address this notion of a growth stock bubble. I'll say this clearly. Experts who like to opine on bonds and inflation should really stay in their own lane. Their endless negative chatter creates a vicious cycle. Stocks get hit at the opening, and the economists tell us that growth stocks always go down with the CPI as if it's like one giant stock, so you might as well just take profits now before they go away. This kind of thinking represents a shocking degree of intellectual laziness. For every set of hot inflation numbers that actually caused the Fed to slam on the brakes immediately, there were dozens that were supposed to trigger the rate hikes that never happened. Yet you hardly ever hear this caveat, right? Because it's taken as a given that these commentators, well, they've got an agenda of chastisement and confusion for you. Whenever the Federal Reserve makes the mistake of listening to these warnings, whenever they tighten in lockstep as part of some sort of hawkish appeasement campaign, it almost always threw the economy into a recession or worse, like we saw with the 17 straight rate hikes in the lead up to the financial crisis in 2007, 2009. So please recognize that the inflationistas, the doctrine of rate hike seekers, they're not on your side. And they are on a side, by the way. They're not indifferent, but they can't make you a dime. I'm there. I'm guaranteeing that. They tend to give bad advice, bad investing advice, because that's not what they do, and they're pushing a policy agenda. However, they can cause you to panic out of your stocks because they sound they're stentorian, they sound so smart. And they never are going to consider the possibility that perhaps, just maybe, the red-hot CPI number could signal a crest in inflation because they do not look at the components. That's what I do. Now, it might not force the Fed to tighten, and even if the Fed tightens, it may not cause you to sell stock. Some stocks will do just fine. Look, if you're running around 100% long or you have margin, then I don't blame you to try to take some profits. But no, it's a good market. All right, so how about this Rivian? What does it signal? Surged another 22% today. IPO. I'm telling you, Rivian is actually not a sign of speculation. It's an attempt to find another stock that can fit the moment when this actual moment right now, when millions of investors are desperate to discover the next Tesla. I say, why not hunt for the next Tesla? What's the matter with that? We used to enjoy the hunt before everyone got so cynical. I remember 30 years ago working on a cover story about finding the next Amgen because that had been a fabulous growth stock. It wasn't embarrassing. It wasn't ridiculous. I wasn't speculating. I was just looking for the next Amgen. We found it. Will Rivian truly be the next Tesla? Too soon to tell. But in an era where the old car companies are still married to the internal combustion engine, even as they all have divisions to get away from that, Rivian's an electric vehicle native, kind of like when I say cloud native for CrowdStrike or Salesforce. It's electric vehicle native. It's got orders from Amazon for virtually every single one of their electric vans, and Amazon owns 20% of the company, so they can will this thing into being. They can will it to be successful. They can will it to make a fortune. So why would you listen to the naysayers who tell you it's insane that Rivian's now worth more than Ford Motor? Who cares? Comparisons, as my mother would say, are odious. I can think of a company that disagrees, by the way. Rivian's fourth largest shareholder is Ford Motor. The big institutions don't agree either. And that's why last night I told you that they keep buying Rivian stock in order to establish positions that are large enough to be meaningful for their funds. And that's what was going on today. This was not hard money. This was easy money. Fund managers want to get a huge position on the sheets, and they need to move fast after getting their first slug of shares from the underwriters. There were no flippers involved. How many times did we say that to you? These were not people who, this was tight as a drum, as they like to say. If you knew about the mechanics of money management, and you knew if you watched the show last night, then you could have made a killing today. Just point it out. How about the supposed death of Fang? Now, I feel like throwing a brick at the TV every time I hear another Fang obituary. I probably heard a half dozen of them yesterday. There aren't enough TVs at Costco to make it so I can do this. Let me tell you, Facebook, now Meta platforms, Amazon, Apple, Netflix, and Google now, Alphabet, are basically crusaders in the fight against inflation. They each offer something that can be used to dampen runaway price increases because they're all such bargains. Facebook's a bargain for advertisers. Amazon's a bargain for shoppers. Netflix is a bargain for anyone who wants entertainment. Google's a bargain for both shoppers and advertisers. Only Apple does not necessarily offer a bargain proposition, although when you consider how many devices the iPhone can replace, I'd say it's a steal at any price. Finally, as far as stocks being broken after weak earnings, listen to me on this, okay? I want to teach you something that I've been stressing to the Investment Club members for years. Now, all my writings are at CNBC. All of my analysis is at CNBC. This is the only place you're going to get my analysis. And you need to search for broken stocks, not broken companies. The most recent broken stock, it's the stock of a company you know well. It's the stock of Disney. Now, if you sold this thing after all the chatter about the disappointing quarter, you would have dumped it down $12. Hey, maybe you'll dump it down $5 tomorrow. I don't know. But let me ask you something. Does this really make sense to sell this iconic company? Only if you truly believe that movies, theme park, and sports are obsolete, okay? Yeah, then sell away. Sure, there are short-term problems, largely because of COVID, not because of Mickey and Minnie or the Avengers, for that matter. But these will all be worked out over time. Layer on the metaverse. Don't you want to be an Avenger? How about one being the eighth dwarf? Don't you want to swim in a pile of money next to Scrooge McDuck? I always liked him. And you could have another revenue stream. Finally, Disney's open-minded. I think gambling's a natural extension of the ESPN franchise. They got to focus on that. Club members got not one but two bulletins about why Disney should be bought here. I am urging you to be a member of my club. We are working 24/7 for you. Now, let's go back to the self-proclaimed bond experts who periodically venture into my lane, the stock lane. Rather than be constructive about what stocks thrive in a higher inflation environment, they want to write off the entire asset class. Why? Because they don't know anything more than S, ampersand, P, and then 5 and 0 and 0. Here's what they know about the S&P. They know there are 500 companies in it. That's it. Okay, not 499 or 501. S&P 500's got 500. There you go. They got horse sense. Bottom line, these inflation fear-mongers are ignorant of how the stock market actually works. They're ignorant about the way companies work. Their arguments are full of holes. So the next time they knock down the entire asset class and tell you to shut the set off and certainly sell your stocks, you should do some buying.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.